Hey everyone, and welcome back to another portfolio update for today. So the Couch Investing portfolio was up 3.39% over the past week, whereas the S&P 500 was actually down 0.46%. Year to date, we are still doing well. We are up now 10.21%, whereas the S&P is up 1.4% on Sunday. Of course, Monday when the market opens, a lot can change. Since the start of the portfolio, we are up 75.96%, whereas the S&P 500 is up 19.63%. We're going to talk a little bit about the moves in the portfolio. I want to touch real quick on the upcoming earnings week, some macro-related data and information that you might want to know. Of course, Tesla did launch its robotaxi service in Austin, so we'll talk about that. We'll talk a little bit about the Iran situation, and then cult stocks, more Google information, and then we'll close out the video with a little recap. Alright, so over the next couple of days we have, I'd say, a handful of interesting companies that will report their quarterly figures. We have on Tuesday before the market opens, Carnival Cruise Lines, then Tuesday after the market close, FedEx and BlackBerry. On Wednesday, of course, I'm keeping my eye on Micron. Of course, this is a company that I own in the portfolio. That's going to be very, very interesting to hear, well, their comments on HBM and then their comments on the business segments and the industry that are maybe still facing some headwinds. Let's see what happens with that. The stock, of course, over the past couple of weeks has been moving in the right direction. And then on Thursday, after the market closes, we have Nike. I just had to double check, and Nike is still a stock worth less than $60. For those interested in gold, inflows to gold funds annualizing a record $80 billion in 2025, definitely outperforming the market more recently. Then if we look at the fear and greed index, well, we are not in greed anymore. We're of course far away from the extreme fear we were at the start of April. We are now at neutral, and of course whatever is going to happen on Monday will of course move this little needle right here. Now, to be honest, I don't really pay attention to this, but every time we have like 3 days of either green markets or red markets, you will see posts talking about, oh, we're now in greed, or we're now in fear, or extreme greed, or extreme fear. Of course, this can be a good, I guess, data point, so you get the sentiment of, well, whether or not you are going to experience some good buying opportunities or some good selling opportunities. But you can also get that basically from the posts on X, maybe comments as well under these videos or under some comments on X, or maybe the talking heads on CNBC and whatnot, if they're more bearish or bullish. If you start seeing some talks about SPACs and this name going up 50%, that name going up 50%, stocks trading at 50 times sales, 100 times sales, and that becomes the norm, then you know that we are in extreme greed and you should be extremely fearful. You should start maybe thinking about what has happened back in 2021. Now, yeah, more recently, and I'll talk a little bit more about that later in this video, more recently we've seen names like, companies that I covered, right? I covered Oscar Health. The next 2 days, stock is up 30%. Then I cover Zeta Global. The next day, stock is up, 19% or so. So yeah, it can be that certain names suddenly start to jump. There's a lot of momentum, whether maybe some have a high short interest or maybe just a large retail following. And these things can, of course, move quite rapidly. ASTS, for example, I covered this company again a month or so ago. Stock was around $23. I believe the stock has doubled by now. So yeah, more recently, it's true that things have definitely gone quite quickly from extreme fear to, I would say in some cases already, extreme greed. What do you think? Moving on to the interest rates. Of course, we've had the Fed meeting. I did talk a little bit about that throughout the week already. So of course, no rate cuts in June, no rate cuts in July, although one Fed did say that, I think it was Fed Waller, saying that July could be when they cut rates for the first time in a long, long time. But currently, if we look at the probabilities for the September meeting, it does seem like September is the one where we're going to see the first rate cut, right? There is a high probability that we're seeing a small rate cut. Over 70% now, because you have 7.1% here for 375 to 400 basis points, we're now at 425, 450, and 64%, 64.7% at 400 and 425. Now, if we move to the December meeting, we can see, and here we're at 375, 400, we can see here 2 rate cuts are definitely happening this year. 3 rate cuts, the probability has come down a little bit. If we go back a month or so ago, that was 24.2%. We're now at 21.7%. A week ago, that was 24.8%. And actually, a day ago, that was 27.3%. A day ago, meaning the day before the last day of the trading week. So 2 cuts this year, I think for sure. 3 is maybe less likely unless, of course, in the back half of the year, CPI, PPI reports, PCE reports are all coming in much better than feared, or the exact opposite, the Fed will just be forced to cut rates because, well, they are late again. Last thing here, macro related. Of course, you've probably heard already what has happened this weekend, and now apparently Iran's parliament approves closing Strait of the Hormuz. Now, here are a couple of important things you might know or not know. 20 to 21% of the world's daily oil consumption, around 20 million barrels per day, and 1/5 of global liquefied natural gas or LNG trade passing through it. The vast majority of the oil that passes through it does go to the Asian markets, and China relies on this trade for nearly half of its crude imports, and it is Iran's largest oil customer. So don't be surprised if oil prices do soar on Monday, right? If we see oil go up again 5, 8%, maybe 10%, don't be surprised. But I'd be surprised if they are going to close it for long periods of time, especially since China is, well, very, very important to them. Moving on to the cult stock part of this video. Like I said, we've seen a lot of the so-called cult stocks move quite rapidly over the past couple of weeks, and actually maybe since the start of this year, right? We have, for example, Hims and Hers stocks up close to 150% year to date. AST up 109% year to date, although that huge move has happened over the past month. We then have Tempus AI also up basically double this year. Robinhood has doubled this year. Then you have D-Wave Quantum up 84% this year. Palantir up 83%. Nebius up 71%. Those are year-to-date numbers. Carvana up 53%. CrowdStrike, I don't know why CrowdStrike is in this list. CrowdStrike is definitely not a cult stock, up 40% this year. Still, that's actually quite an amazing performance. Oscar Health up 36% year to date. Of course, the big move happened because of me, of course. I'm just kidding. I'm not gloating, just making jokes here. Calm down. Rocket Lab is up 9.52% year to date, but of course up 480% year over year. Lemonade up also 9% year to date, but 150% year over year. AMD, is it a cult stock? I mean, if I call AMD a cult stock, then I guess Nvidia is also a cult stock, and Tesla is here on that list as well. Tesla year over year is up 77%, but year to date down 17%. Grab is definitely not a cult stock, although it did have like this one weekend where it suddenly became the most popular stock out there because Amit posted about it. So, okay, I guess that's why, but I would not call it a cult stock. Archer, popular for retail, but again, not a cult stock in my opinion. SoFi is definitely one. SoFi is definitely a cult stock. I'm probably part of it, although I'm not that crazy when I talk. I mean, I love the company, I love the stock, but I'm not cultish behavior, right? I think so. And by the way, all of this, right, the labeling of cult stocks and whatnot, all of this is just to show you that retail can outperform the market if, of course, they do their due diligence, if the timing is right as well. Of course, there are some companies where, yeah, stock is up, but that doesn't necessarily mean that your thesis is playing out. The stock going up thesis works out. But if the business is still not generating any revenue or any profits or whatsoever, then your thesis is not playing out. Wall Street is just, well, pushing a stock up and up and up, and that's about it. So, yeah, sometimes, actually more recently, a lot of the times, retail does know how to pick real winners. Of course, these are short-term things, right? A year to date. I'm not really going to say that, oh, this is the end game now. No, not at all, but it is a nice start. Now, going back to the portfolio, not much has changed. SoFi is still here, number 1, PayPal 2, Alphabet number 3, despite Alphabet dropping just a little bit over the past couple of days. Micron has been doing very, very well at $123, which of course, I like to see. I'm up 38% on that position, and that position didn't exist at the end of 2024. So I'm quite happy with that. Although going into this earnings report with such high expectations is usually not how I like to play these things. I'm not going to sell, but even if we have a good earnings report, because probably a lot of it is now priced in, right? Because not so long ago, actually, Micron was, a month or so ago, we were under $100. And actually, in April, this stock was trading in the $60, $70. So yeah, we're definitely coming from a long way. Then we have Rocket Lab. Rocket Lab finished the week above $30 again. So quite happy with that performance, of course. Then Uber, of course, will come under pressure now under pressure from a narrative point of view. Business-wise, I don't think anything will change right now, and in the future I'm still quite bullish on Uber. Stock did take a small hit or so, I think, on Friday. Then AMD has been making moves. AMD was actually above $130 on Friday. We finished the week at $128. Nebius, still very, very strong performance there, still closer to $50 than $40. Hopefully we might see a small, tiny correction so I can grow that position even more. Then we have this struggling Intel here, still at $21. Believe it or not, this thing is not really moving much, but I do think that Intel will be a stock that will move on major announcements, hopefully starting in the next earnings report and earnings call. Then we've got here Alibaba sitting at number 10, $113. This one has also been a little bit more under pressure. Remember, this was a stock that was above $120, I think $130, close to it not so long ago. Meta back under $700. So who knows? Maybe we'll have opportunities to add a little bit more to Meta here. Tesla is at 322. Of course, depending on how the rollout of robotaxis are evolving, the stock will move accordingly. We have here dLocal still sitting around $10, and this is a stock that I did buy a little bit more over the past couple of days, increased the position by 9.40%. And yes, I did finally sell all the rest of my shares in Celsius, basically broke even, as I say here, lost interest, will increase cash position to deploy during a rainy day, did increase the cash position, but did also already acquire 100 extra shares of dLocal. And now you might say, oh, you're very bullish on dLocal, and yet it's only 5% of this portfolio. That's true. But don't forget that dLocal is a stock where it hasn't really moved much. I'm only up 1.2% here, while all the rest I'm up double digits, some of them already triple digits. So once dLocal starts to move on its way up, it will of course become a larger chunk of the overall portfolio. Now we have cash position here, 420, nice. Then Appcelera, yes, I will still talk about Appcelera in the future, still just a speculative play in the portfolio, 1.43% of the portfolio, although right now we're not down that much anymore, we're only down 11.8%. Owlet has been performing extremely well, although I don't really care much because it's under 1% of the portfolio, but I'm still up 60% on that position. And then the other two positions here, 2 shares of Nvidia and 1 share of Palantir. I did add United Health to the watch list because we're back at $300, and the more and more I look at that company, especially after I've looked into Oscar Health, I looked into it $16 or so. We're now at $21.22. Zeta Global, you know, I covered this right after Oscar. This was a company worth $12.79. We're now at 14.18. Of course, these are companies that can easily double and not really be that expensive, right? All things considered. But as I say, I don't like to chase. And with Oscar Health, as I've explained in the video, it is a very, very interesting company. The problem is that the industry, health insurance politics, all of that in the United States, it's very, very complicated. And even with all of the research, even with seeing the potential of Oscar Health, especially seeing the market cap of the company and the total addressable market, you are very much, well, inclined to choose that over maybe a potential United Health, for example, right? Just for the pure upside. But like I said, I also don't want to chase. And with United Health, I can still get, in my opinion, huge outperformance and not have the risk of, well, maybe this part of the business will not do well because suddenly there is a change in ACA, in Medicare, Medicaid, and that could impact Oscar Health. And since they are just much smaller, not as profitable as United Health, then it might hurt the stock's performance, etc., etc. There is a lot of calculation, of course, behind whether or not you want to choose one player over the other. Of course, if United Health was not down 50% or so, 40% or so, then yes, there would not have been any discussion here. But since it is down that much, and since it is still generating, $400 billion or so in revenue, its new CEO is the old CEO, which was very, very successful at the company. I mean, yeah, it would be a very, very smart move to go with United Health over Oscar, although Oscar would provide maybe more upside in the short term. I mean, since I made the video, stock is up over 30%, so I guess that's already a huge, huge outperformance, right? So I am here still debating which one to pick. And as I've said to plenty of you in the comments, if I were to pick, probably Zeta is more in my circle of competence, right? It's way easier to understand. So we'll see. If I make a buy, of course, if you follow the portfolio, you'll get a notification. Now, moving back to Tesla, it is a big day today because the Robotaxi app is live. So this is basically the home screen. And this is the geofenced location where the Model Ys full self-driving are going to drive right now. This is from Sawyer Merritt. Basically, you see this map, you can order it, you can look at parks, fast food, cafes, etc., etc., and then you order it for a flat fee of $4.20, of course. Now, if we compare this geofence area to the blue part, which is where Waymo operates in Austin, of course, it is half of, let's call it half of where Waymo operates, but this is just day one. So this is definitely a big day for us Tesla shareholders, and congratulations to the Tesla team. Moving on to Google, the most profitable company out there. So these were some projections by Goldman Sachs, search revenue projections for the next couple of years, and the YouTube Shorts projections as well. So as you can see, these are the annual on the left here. These are the annual projections shared by Kaushik on X for Google search and other gross revenues. So 2025, $212.4 billion. 2030, 317, let's call it $318 billion. That translates to 7.3% year-over-year growth in 25, 8.8 in 26, then 9.5, 8.6, 7.9, and then 7.2% year-over-year growth in 2030. Okay, this might not be growing double digits, but this is still very, very good. And remember, this is a pretty profitable business as well. Then if we look at YouTube Shorts projected revenue, that's projected to be growing at 26% compounded, 25 to 2030, going from just over $3 billion to $10.5 billion in 2030. Of course, these are projected numbers, estimates. These things can, of course, change over time. But yeah, I mean, I don't know how many times I can repeat myself with Google. This is just a very, very cheap company and an amazing company that right now the narrative is just not with them. But that can, of course, change very quickly. Actually, if we look at some similar web data here for the month of May versus April, month over month traffic change, leading Gen AI tools, ChatGPT up 6.8%, Gemini up close to 29%, DeepSeek down 9%, Grok down close to 9% as well. Perplexity was up 12.14%. If we look at app downloads for all Android devices, Google Gemini crushing it here. Basically, what is it? Almost 100 million difference compared to Grok. So yeah, I mean, the data would suggest that Google is not a dying business. Post on social media, from people maybe that are bullish on other companies or that are using other apps will tell you that it is a dying business. But as I've shown you time and time again, Google, for a dying business generating over $110 billion in net income, is doing a very, very bad job at dying. And then lastly here, a quick note on the big tech companies, right? Because I've talked about the Coatue presentation a little bit, but maybe I'll repeat it again in this video to end this episode. So big tech companies, of course, are a sort of safe haven, I'd say, in this volatile, uncertain time, because these are companies that are money-making machines, right? Okay, maybe Tesla right now is not a money-making machine, but you have your Meta, Microsoft, Nvidia, Apple, Amazon, Alphabet. These companies really print money, basically. And so these were the companies where you basically put your money in and you've probably been outperforming the market. Although Amazon over the past 5 years have been underperforming the market, I think that can change quite quickly from here on out. But as I've shown you this week, right, over the past 5 years, I mean, they've been outperforming, Amazon not much. Year to date, Meta is outperforming, Microsoft is now outperforming, Nvidia is up 6%. Of course, the Nasdaq is only up 1%, S&P 1% as well. But Amazon, Alphabet, Tesla, Apple, all underperforming. And so could these names still be very attractive going forward, since they have been underperforming the market, while a lot of the smaller players, right, as we've seen the cult stocks, have crushed the market, right? Their performance year to date, I mean, if you're up year to date 100% on one position, you are of course crushing the market, not just year to date, but for a couple of extra years as well, unless the stock crumbles down and crashes 50% or more, of course. But it does seem like right now the market has been chasing a lot, has been trying to look for other winners. We just came off 2 years of above 20% returns for the market. And so in year 3, what we're seeing right now is that, well, the market, the money is flowing out of the big names and going into the smaller, more, let's call it speculative ones, that are maybe growing faster, might not be as profitable as the big tech players, but definitely stock return wise, they are outperforming and then some. But could this mean that suddenly the outperformance for big tech is coming, maybe in the back half of the year, maybe exiting 2025? What do you think? To me, I don't know, it's an open-ended question. Of course, to me, with Alphabet, I think it's the biggest no-brainer out there, big tech related. What do you think? Let me know down in the comment section below. And so all in all, that's about it for me in this video. United Health, Oscar or Zeta remains to be seen. But as I've said in the last 2 videos, in Zeta and Oscar, it's more to put them in the speculative basket than anything else, right? It's just put in that basket. It won't be a big percentage of the portfolio regardless. With United Health, it might actually be a bit larger than just a speculative play. But we'll see. I still need some time to think. Do let me know your thoughts down in the comment section below. Like, subscribe, all of that, and I'll see you all in the next one. Bye-bye.